Hi everybody, and welcome back to video number 4 in chapter 21. And when we left off, we were looking at examples of a change in reporting entity. And here, number 1, presenting consolidated statements in place of statements of individual companies. Number 2, changing specific subsidiaries that constitute the group of companies for which the entity presents consolidated financial statements. And number 3, changing the companies included in combined financial statements. And number 4, changing the cost, equity, or consolidation method of accounting for subsidiaries and investments, reported by changing the financial statements of all prior periods presented. Okay, let's take a look at an illustration. This illustration shows a note disclosing a change in a reporting entity from the annual report of Hewlett-Packard Company. And here, Hewlett-Packard says they've implemented a new accounting pronouncement on consolidations. And they've adopted this new pronouncement and consolidated the accounts of Hewlett-Packard, a wholly owned subsidiary that was previously accounted for under the equity method with those of the company. The change has some effects as outlined in this note. I think I'll let you read that on your own. And here, let's put this into practice a little bit with the change in estimates. Here, during 2025, Lopez Company changed from the double declining balance method for its building to the straight line method. The building was purchased on January 1, 2023, and originally cost $600,000. It had a useful life of 20 years and a salvage value of $20,000. Depreciation on both bases for 2023 and 2024 are shown as follows. And here's the straight line method. Here's the double declining balance method for 2023 and 2024. And here they want you to prepare the journal entry to record depreciation expense for 2025. Well, a change in depreciation method is considered a change in estimate affected by a change in accounting principle that should be accounted for prospectively. Lopez will use straight line beginning in 2025 and will not retrospectively adjust prior financial statements. Computations to determine depreciation expense for 2025 are as follows. So here, the cost of the building, $600,000, back out prior depreciation expense, giving us a book value of $486,000, and then we back out our salvage value, and the remaining depreciable cost would be $466,000. And we've already depreciated 2 years, so there's 18 years remaining. So we take the $466,000 and divide that by the 18 remaining useful life years, and we get $25,889. And so the journal entry follows with a debit to depreciation expense and a credit to accumulated depreciation buildings for that same amount. Okay, describe the accounting for correction of errors. Now, here we have a change from an accounting principle that is not generally accepted to an accounting principle that is accepted. An example of that would be changing from cash basis accounting to accrual basis accounting. The rationale is that the company incorrectly presented prior periods because of the application of an improper accounting principle. Mathematical mistakes. That's pretty easy to understand. Here we're incorrectly totaling the inventory account sheets when computing an inventory value as an example. Next, changes in estimates that occur because a company did not prepare the estimates in good faith. And an example would be adopting a clearly unrealistic depreciation rate. The next error would be a flat oversight. And here the example would be failing to accrue or defer certain expenses and revenues at the end of a period. The next error would be the misuse of facts. And the example is failing to use salvage value in computing the depreciation base for straight line method. And then finally, an incorrect classification as an error. Here the example was classifying a cost as an expense instead of an asset, and vice versa. Okay, so here, expense recognition, recording expenses in incorrect periods or for an incorrect amount. Revenue recognition, improper revenue accounting. That category includes instances in which revenue was improperly recognized, questionable revenues were recognized, or any other number of related errors that led to misreported revenues. Misclassification. Here we are misclassifying significant accounting items on the balance sheet, income statement, or statement of cash flows. These include restatements due to misclassification of short or long-term accounts or those that impact cash flows from operations. And allowances / contingencies. Here, errors involving bad debts related to accounts receivable, inventory reserves, income tax allowances, and loss contingencies. And the next category is long-lived assets, asset impairments of property, plant, and equipment, goodwill, or other related items. The next category is taxes, errors involving correction of tax provision, improper treatment of tax liabilities, and other tax-related items. And the next category is equity, other comprehensive income. Here, improper accounting for comprehensive income equity transactions, including foreign currency items, unrealized gains and losses on certain investments in debt securities, and derivatives. And finally, inventory. Inventory costing valuations, quantity issues, and cost of sales adjustments. So, how do we report those? All material errors must be corrected. Pretty obvious there. Number 2, we record correction of errors from prior periods as an adjustment to the beginning balance of retained earnings in the current period. Number 3, such corrections are called prior period adjustments. And 4, for comparative statements, a company should restate the prior statements affected to correct for the error. I might say that in my career, I've never had a prior period adjustment. That's a material error that I would have missed, and my outside auditors would have missed, and my people would have missed. It's a real black mark on my record as a chief financial officer to have done that. But if it does happen, I'm not trying to underscore this as a rare situation. If we do have corrections, we do need to do it just like we are reporting here. Okay, let's take a look at an illustration. Prior period adjustment and restatement. In this illustration, in 2026, The bookkeeper of Selectro discovered an error. In 2025, the company failed to record $20,000 of depreciation expense on a newly constructed building. This building is the only depreciable asset Selectro owns. The company included the depreciation expense in its tax return and correctly reported its income taxes payable using a tax rate of 20%. So here is the income before depreciation expense. Here's the depreciation expense. So our income before income tax would have been $80,000. The current income tax expense was $16,000. There was no deferred income tax expense. So the net income here would be $64,000 without the error. But with the error, we would have $100,000 of income before income tax because the depreciation expense had not been subtracted. And we would have recorded current income tax expense of $16,000 with $4,000 deferred income tax expense totaling $20,000. Net income would have been significantly higher at $16,000 higher at $80,000. All right, error entries. The following are entries that Selectro should have made and did make for recording depreciation expense and income taxes in 2025. Because Selectro did not record depreciation expense of $20,000 in 2025, a temporary difference between pre-tax financial income and taxable income occurred, which created a deferred tax liability in 2025. So the entries the company should have made without the error would have included the $20,000 depreciation expense and, of course, the accumulated depreciation on the buildings. And there are the income tax expense of $16,000 with income taxes payable, a credit of $16,000. But what the company did make with the error, they made no entry for depreciation. They recorded the $20,000 of income tax expense, and $16,000 of it was income taxes payable with deferred tax liability of $4,000. Okay. So, illustration 21.12 shows the income statement comparison of error correction, and illustration 21.13 shows a comparison of the correct and incorrect journal entries. So the question is, how does the error affect specific items on Selectro's income statement and balance sheet for 2025? And the solution is the $20,000 omission error in 2025 is going to result in the following effects. On the income statement, income is understated by the $20,000 of depreciation expense. Income tax expense is overstated by $4,000, which is the 20% enacted tax rate times 20%, which is $4,000. Net income is overstated by $16,000. And then on the balance sheet, accumulated depreciation is understated by $20,000, while deferred tax liability is overstated by $4,000, representing the $20,000 times the 20% enacted tax rate. That looks like a good place for us to stop this video. And when we return, we'll take a look at the correcting entry. Until that time, bye for now.